Yo, it's your boy Phils, and welcome back to another interesting episode on Top of FX. And today I'll be analyzing the US dollar, Canadian dollars. And first of all, I want to wish everyone a Merry Christmas, and I hope everyone had a good and fun celebration. So the first thing I always is to go to the highest time frame in order to get the overall perspective of the market. And whenever I'm on the highest time frame, I always try to look at the behavior of the market, the order flow of the market. What is the market doing? Is it making higher highs, higher lows? Or is the market making lower lows, lower highs, or is it moving within a range? So that's the first knowledge though. So to give a brief recap of the states you can see the market is either you get the market moving within a range. So you have this. So this is a ranging market. And for a trending market, what you have is a wave pattern, a 5-wave pattern for a downtrend. And for an uptrend, you have a 5-wave pattern. 1, 2, 3, 4, 5. And I also said at the end of this 5-wave pattern, what you could have is either you have a reversal or you have a correction. A reversal, a correction is an ABC pattern, so it's an A, B, C pattern. Well, if you get a reversal instead, what you get it's a 5-wave pattern for a reversal. So if you're after the 5-wave pattern, I'm using an uptrend as an example in this case, but it also applies to a downtrend, but the other way around. So you have a 5-wave pattern. So at the end of the 5-wave pattern, there are two possibilities. Either you have a correction, which is an ABC pattern, or you have a reversal, like a 5-wave pattern comes next, and that leads to a different change of trend. This leads to a continuation of the uptrend. So this leads to differentiation of trend. So yeah, so let's jump around it. Let's go back to the chart and let us see what we can have. So down here, I could see like this is a corrective wave. This is a big ABC pattern. Why did I say so? This went upward and led to the break of the structure. As you can see, this is the break of the structure. So definitely this was an ABC corrective wave. So this is an ABC. So what I'm basically doing is like dissecting the market. Even though I'm on a monthly time frame and you can't really trade on the monthly time frame, it's best to like get the directions on the market, so to get the market structure. And doing so will give you the direction on where you are supposed to be trading on the lower time frame. So this is an ABC pattern. The C wave is always a 5-wave pattern. So if you get this, it's 1, 2, 3, 4, 5. So you can see at the end of this 5-wave pattern, what came next was a reversal. Like I said, if you have a retracement or a correction, it just gives you an ABC pattern and the trend continues. But look what happened at the end of this ABC, this corrective wave. What came next was a completely new trend that broke the structure. So basically, this was a downtrend. This was a correction in the market, and this was a continuation of the trend. So basically, let's say this is an invisible first wave down here. This was the first wave down here. Then this is the second wave, which is a corrective wave. This is what we have down here. This A, B, C. So this is the second wave, and this third wave is this third wave down here. There's the fourth wave, and there's the fourth wave. So what we see now, I think we are an overall downtrend because the market is making lower lows and lower highs. You can see this is a high and this is a high. This is a high. This was a high and this was a low. This was a low and this was a high. This high is lower than this high. This low is lower than this low. This is lower low, lower high, which qualifies it for a downtrend. So you can see this is a downtrend. Like this was a high, this was a low, it's a high, low, high, low. So the market is making lower lows and lower highs. So if I say this is a downtrend, the downtrend always unfolds in a 5-wave pattern. So what expect a 5-wave pattern from this. So I can get my drawing tool, and with the aid of the trend channel, I could see that this was a massive move downwards, before a retracement. Then get this trend channel, put the midpoint at the end of the first wave, so the midpoint ends here, and that will give all the give us the start of and that will give us the end of the third wave. So we can get by drawing to this first wave, second wave. This is where the third wave ended before a retracement. Third wave, the fourth wave, and the fifth wave. So in this case, we have an elongated fifth wave, which is quite rare because what we usually have is the third wave being elongated. Usually, in most cases, the third wave always have the biggest magnitude among the first wave and the fifth wave, which like I said, impulsive wave because they go in direction of the trend. But in this case, what we got was a elongated fifth wave, and to be sure I drew the Elliott wave correctly, what I usually use to confirm my drawings by just going down to the line graph, and that will give me the fractals properly. So you can see, so I can just get my you can see that this it's here. I think this is meant to be at this area down here. This is the third wave, then the fourth wave starts from here. So this is the first, second, third, fourth, fifth. So you can see I have been able to, like, I changed the candlestick from the candlestick pattern to the line graph, which gave me the fractals properly, and I could use that to draw the fractals of the Elliott wave. So you can see this is the first wave, second wave, third, fourth, and fifth, which is quite an elongated wave. So what comes next after a trending market is either a corrective wave or a reversal. A corrective wave is an ABC pattern. A reversal is like a new trend entirely, which is the 5-wave pattern. But what we could see down here is I could see a shape of a 3-wave pattern. There is A, B, C. So this is a correction. So this is a corrective wave. So this is an A, B, C pattern. So at the end of this C wave, which is the 5-wave pattern, what comes next is a new bearish trend, which is also a 5-wave pattern. So at the end of this whole 5-wave pattern, what we're going to expect next is a 5-wave bearish pattern. So what we're going to do rather is to count the fractals of this C wave. Get my drawing 2. This is the first wave, second wave, third wave, fourth wave, and the fifth wave. The market has been making higher highs and higher lows. You can see it. This is a high and this was a low. This was a low, high than this low. This was a high, higher than this high. Because whenever a structure is breaking, a new high is always formed. So this was the old high, then this high got broken, and that formed this new high. So you can see higher highs and higher highs. The market was making higher highs, higher lows on this C wave, which is the 5-wave pattern. So what came next is like once you have a high, what should come next should be a low. Once you have a high, what next should be a low, which should be higher than the previous highs and lows. So this was higher than this, and this low was higher than this low. So what we're to expect should be a high that breaks this structure, because I said once the structure gets broken, once the major structure gets broken, you have to expect a new high. So we're to expect a price that was. So we're to expect the price to break this structure to give us a clear high, and also go downwards and give us a higher low, higher than this. But what we had instead was, what we got instead was the buying pressure couldn't push this price any further upward. So that's why you have this long wicks candle down here. So you had a lot of buyers that were not able to take this price further upward. So that signifies sellers coming into the market because the market is always a battle between buyers and sellers. So in this area, the sellers didn't have enough pressure to push this price upward. So what happened was the market came downwards. So let's say it couldn't push this price any further upward. You could see that did it break the structure? It didn't even break the structure. So even if let's say this was a high, what should come next should be a higher low. But instead, what we got instead was a break of this structure instead. And using smart money concept, that is called change of character, which signifies a trend reversal. That is change of character. The break of this structure means change of character, which is a trend reversal. And also by also using smart money concept, we found out that a lot of bank and investors had a stop loss at this area because they took this buy trade that led to the break of this structure down here. You can see it took break structure, so there was like a lot of orders down here. And also you have retail traders that trade based on area of support and resistance. So a lot of retail traders, they think that once the price breaks through an area of support, it's gonna go down, and when the price breaks through an area of resistance, they're gonna go place a buy trade. In this case, a lot of retail traders place a sell order down here, like a sell stop order with a stop loss probably around here. So the market came down here, which is like the market makers, like the big banks and financial investors. What they do is that they manipulated a lot of traders with their huge amount of money into making them feel as if they were right for some minutes or for some days. And what came next afterwards was a reversal. So it came downward, took out the whole money rest down here, the stop loss, those that are waiting to sell the market, and guess what? It deceived them, tricked them, and it went a bit upward. And also, why did the price go down here? The big banks and all these large investors. Another reason why the market came to as low as this area was because the big banks, large financial investors, and the rest of them, like before they took this buy trade, they took a sell position down there. You can see this massive sell. Why? Because they did that in order to get a good entry into the market. So why they were in profit from taking this buy trade, they had an open position that was at loss because this was a sell position that was open. So they can't be at loss because they control the market. These guys use their billions to manipulate the market. So what they did instead was, when the market came and when they took a buy, so what they did essentially was, when they took a buy position, they had this area as a target because you have a lot of liquidity resting down here at this major swing high. They came down here, took the money resting around this area, and guess what? They manipulated the market towards closing their sell open position. You can see this candlestick, this long candlestick. So this is a large financial institutions at work. This whole sell, this whole area. Of course, you can streamline the you can refine the candlestick, because even if they have a sell position down here, they also have a massive sell around this area because this is an order block in the market. So you have a lot of money resting down here. The market makers came down here, took them out of the position, and reversed the direction of the market. If you have an idea of the Elliott wave and how to use the Elliott wave properly, you will know that at the end of an C wave, what comes next is a trending market, which is a bearish wave. So what to expect here is like a 5-wave pattern that will come and take out the liquidity resting here properly. So what to expect is a 5-wave pattern, which is 1, 2, 3, 4, 5. For those guys for those swing traders that want to swing this trade, they can say, okay, then I'm going to wait for the end of this corrective 4th wave pattern, which is an ABC pattern. So at the end of this 4th wave pattern, then they can get the Fibonacci retracement tool, put it down here. So let's say anywhere from 0.5 upward is your premium, because you intend on selling this market. So if you want to sell this market, you wait for the price to get your premium, which you can see that's already around our area of premium. Why did I say premium? So using the Fibonacci retracement, 0.5 upward is your premium area, and 0.5 downward is your discount area. When you intend on selling, you sell when the price is high. So when I say premium, I mean the price is high. So let's say, for example, you bought something at a very low price and you intend on selling that stuff, and you check the markets to see the price on that item you got that you intend on selling, and say the price is high, you sell. Also, if you intend on buying, for example, you want to buy a computer and the price was very high, and you wait until Black Friday, and where was a discount on that item, you will rush. A lot of people want to buy that item because the price is now low at a discount. It's not being sold at a discount, so it's a cheap area. So the same principle applies when trading. Like you buy when the market is at premium, you sell when the market is at premium. That's when the market is high, and you buy when the market is at discount. So just to go further. So since we're on the fourth wave, this is the fourth wave down here. Our aim is to short the market at the end of this ABC pattern, which is an ABC pattern. Already I could see this is this A, B, C. But if I go down to the lower time frame to see the fractals properly, let me go down to the weekly time frame. So for the weekly time frame, this is the first wave, second, third, fourth, fifth. So now to explain what's happening down here, this is the fourth wave. But what is the market doing? What is the market trying to do? Or what are the market makers, which are the like large banks, large investors? What is the plan? Is that at this area down here, there's a lot of money in the market around this region. Why do I say that? This is an important area in the market. Why do I say that? Because this was the last upward move before this large selling order in the market. You can see this large bearish move in the market. So this was the last upward move before this large bearish move in the market. So that is the influence of the market makers, like the banks, large financial investors. So what did they do down there is that before they took this sell trade down here, they first of all buy. You can see this green candlestick. They bought. Why did they buy? Now to get a very good price entry, and also to shake off retail traders like me and you trading from home. So in doing so, that will give them a very good entry point to sell the market, and they were at profit down there. But what happened is that they had an open position that was still open, which was a buy position. So they bought to push the price upward. So they had an open buy position. So even though they were in profit down here, they were at loss around this area. I think it's called hedging also. If you can read about hedging, how the banks hedge the market and all of that. So they bought before selling the market. The banks don't like being at loss. The banks don't like any form of loss whenever they're trading. So even if they're at loss, or even if they make loss, it's always a minimal loss. That is the lowest loss they could get from trading. So what the would bank do is that after taking this sell trade, they will also manipulate the market to go upward and close their open buy position that was down here. So that makes this area a very important area, because there's a lot of money resting down here, because you have banks that have the open position down here. And secondly, for retail traders, they are trade based on area of resistance and support. A lot of retail traders will see this as a break of area of resistance, and they'll place a buy stop order down here and hope that on the break of this structure, the market will continue going upward and upward and upward. But look at what happened. The banks came downwards. They down here. They knew that there's a lot of money resting down there. So what happened was that they tricked a lot of traders towards taking a buy trade. So a lot of traders that took the buy trade were at profit until the price got to this area, and you saw was a drastic fall in the markets, which obviously triggered a stop loss in the market. So that's what banks are always doing. So if there's an A, B, C pattern, what to expect a 5-wave pattern out of this. So if we get the trend channel, this A, you can see this is the first wave, second wave, third wave, fourth wave, fifth wave. So to sell this market, what I'm going to wait for is, like, I want to wait for the break of an internal structure. That's what you wait for, the break of internal structure. So the banks, what they're going to do right now is that at the end of this fifth wave, that will start this whole 5-wave pattern. So there are two things you can do. Either you want to be a long-term trader, like a swing trader, to swing this market for months or so, or you can say, okay, you know what, I'm gonna like go into the market, I'm going to sell this market, and I'll take my profit around this next area of liquidity, the resting down here. So you can say, okay, I'll take a sell trade, and when the market gets to this area, I'll take my profit. So I'll analyze both scenario for you guys to see. So change the color of this to, let me change the color of this to yellow. Put this white color, so you can see. So what we expect next is a smaller 5-wave pattern, which is this. But obviously, when I'm on a weekly time frame, for a swing trader, this is a smaller wave pattern because you have to wait for weeks for this 5th wave to be completed. Then this market has to be broken, which will take probably like 2 months for that to happen. But the thing is that you have the privilege of just placing your trade with a stop loss somewhere up here and just living to run for months, you know. But if you don't have the time for that, if you just want to be get into the market in coming days and intraday traders, you can take advantage of this market from where it is. Because right now you can see this is a small bullish 5 wave, but on the lower time frame is a massive bullish wave because we're on the weekly time frame. So if I go to the daily time frame, but before doing that, let me analyze from a swing trader point of view, you know. So a swing trader will, once this market gets broken, or just get broken, to get number of pips for a swing trader will be put this downwards. This will be a target level down here. This is a target level down here because this is an external liquidity in the market. You have a lot of money resting down here. Swing trader, this the number of pips you're gonna get from this market. If you can just wait for the break of this structure, this will be about 4,171 pips, which is quite a lot. But one, it takes a lot of time. It will take a lot of months before the price gets to that level. Also, to not to be greedy, just to get your money. If you don't have much time to wait, you can also be a swing trader as well, and you wait for the break of that market at this area down here, and you take a profit at this level down here, which is about 1,359 pips, which is still quite a lot down there. But if you don't have that much time, you don't have the patience for you to trade, and you want to I want to go in now, then you can be an intraday trader by just leaving your trade for a few days. But in that case, you won't be waiting to sell the market. You'll be taking advantage of buying this market because right now we're still on the smaller 5th wave pattern. So we go down to the daily time frame. This section is for intraday traders or scalpers or whatever your trading pattern is, you know. But the main thing about understanding market structure and knowing what's happening. So these are the last 5th wave pattern. So you can say, okay, I don't have the time to sell this market or to swing this market. I want you to just enter the market right now. Then in that case, you'll be dealing with a bullish, smaller 5-wave pattern, which is quite a lot. It's a lot of pips, you know. So in that case, your target level should be at this area because this is the major area of this was the external liquidity in the market. Because you know, liquidity rests on major swings, so you have money resting down there at this area. A lot of bankers short the market that push the price downwards, you know. So you have a lot of money resting down here, and you also have a lot of people that have the buy stop that are willing to buy this market to when the market breaks this area of resistance. That's for some retail traders. So in that case, that brings a lot of money into the market. That will generate a lot of money around this region. That will generate a lot of money around this area down here, because banks are always seeking liquidity. That's the main aim. They take out internal liquidity to head towards external area of liquidity, you know. So what I mean by external liquidity, this is an external liquidity swinging on the major swings, you know. So what you can do right now is to analyze this market. How do I enter this market? But whenever you enter this market, you should be looking for just buy trade only. And when you get a buy trade, your main target should be around this area down here. So let's say if I get my trend channel and draw the fractals of this, which should be a 5-wave pattern. So what to expect will be this. is 1, 2, 3, 4, 5. So you get the main point right now. Today is just it's not for. I don't want to go down to the lower time frame because that would just make the work all messy and all of that. But you get the idea. Like if you're an internet traders, you should be looking for just buying opportunities. So where you just by you reading the fractals, going down to the lower time frame and making sure your market structure to know that you're buying from an area of discount, not an area of premium. So even if you are to be buying this market, or you plan on buying this market, you should buy from area of discount, not area of premium. Because when you buy from area of premium, you will probably be in a long drawdown. Even if the price gets to your target location, you'll still be in a long draw, in a very large drawdown. So you don't want that. You don't want that. You want to buy where the markets are discount. And that's it for today, guys. And in case you haven't subscribed, don't forget to subscribe and hit the like button if you get 1 or 2 things from this video. I will see you guys on the next episode on my channel. Thank you, guys.